Financial freedom is not a number. It is a relationship between what you need and what you control. And the reason that distinction matters is because the industry that sells you financial freedom wants you focused entirely on the number. Because the number is a product they can sell you tools to chase forever without ever quite arriving. Ask 10 people what financial freedom means, and most will describe a dollar figure. $2 million, $5 million. Enough to never work again. The number varies wildly depending on who you ask, which is itself a clue that the number is not actually the thing being measured. What is actually being measured underneath the number is something more specific. The point at which your assets generate enough income to cover your life without requiring your labor. That definition is precise and it is useful because it immediately reveals two levers instead of one. Most people only see the first lever, grow the assets. Fewer people examine the second lever, which is often more powerful and completely within their control right now. Shrink what your life requires. Here is the math that almost nobody sits with directly. The standard rule for sustainable withdrawal from an investment portfolio is roughly 4% annually. The amount you can withdraw each year, adjusted for inflation, with a high probability of the portfolio lasting 30 or more years. This means your number for financial freedom is your annual expenses multiplied by 25. If your life costs $40,000 a year to run, your number is $1 million. If your life costs $80,000 a year to run, your number is $2 million. The number does not primarily depend on how much you earn, it depends on how much you spend. Two households earning identical incomes can have financial freedom numbers that differ by a factor of 2, entirely based on lifestyle. This is the part the industry does not emphasize, because the industry sells products tied to asset growth. Investment accounts, insurance products, wealth management services, not products tied to expense reduction. There is no commission on choosing to spend $50,000 a year instead of $90,000 a year. There is a substantial and recurring commission on managing the additional $1 million you would need to sustain the $90,000 lifestyle. The industry's economic interest and your fastest path to freedom are not aligned. That does not make the industry corrupt. It means you should notice which lever gets emphasized in every piece of financial content you encounter and ask why. Now hold the honest complication. Because expense reduction has real limits that lifestyle minimalism content tends to ignore. There is a flaw beneath which cutting expenses stops producing freedom and starts producing deprivation. Housing, healthcare, and basic security cannot be cut indefinitely without consequences that are not worth the savings. The person who moves to a cheaper apartment in a dangerous area to save $300 a month has not necessarily improved their financial position if the trade-off includes chronic stress, unsafe conditions, or a worse commute that costs them time and career opportunity. The math of financial freedom is not just about the smallest possible number. It is about the smallest number that still supports a life you would actually choose to live. And for a meaningful share of Americans, the floor itself is simply high. Healthcare costs, geographic requirements tied to employment, family obligations, disability, caregiving responsibilities. These are not lifestyle choices that can be optimized away. The framework of financial freedom, applied without acknowledging this, can slide into blaming people for structural costs that are largely outside their control. A single parent in a high cost of living city with a chronic health condition does not have the same expense reduction lever available as a healthy single person with remote work flexibility. The math is identical. The available inputs are not. This is where the honest version of financial freedom diverges from the version sold in most content about it. It is not a universal formula that works the same for everyone who applies enough discipline. It is a ratio that depends heavily on circumstances that are not equally distributed. Now look at the asset side of the equation, because this is where the timeline actually gets built. Someone earning $70,000 a year, spending $50,000, and investing the $20,000 difference at a historical average market return of 7% annually would reach a $1,250,000 portfolio, supporting the same $50,000 annual expenses at a 4% withdrawal rate in approximately 25 years. That is the entire career. Reduce the spending to $40,000 and increase the savings rate to $30,000 annually, and the same portfolio target is reached in approximately 18 years. The 7-year difference is not produced by earning more. It is produced entirely by the gap between income and expenses, and by what that gap does when compounding is given enough time to work. This is the actual mechanism behind every early retirement story you have encountered. It is rarely explosive income. It is almost always an unusually wide gap between what is earned and what is spent, sustained over enough years for compounding to do the heavy lifting. The people who reach financial freedom fastest are not usually the highest earners. They are the people with the largest gap, regardless of the specific numbers on either side of it. Here is the part that reframes the entire concept. Financial freedom is often described as an endpoint. A finish line you cross and then stop running. In practice, the ratio between assets and required income is not binary. It exists on a spectrum, and every point on that spectrum buys you something real, well before you reach full independence. A household with 6 months of expenses saved has freedom that a household living paycheck to paycheck does not. The freedom to leave a job that has become intolerable. The freedom to negotiate rather than accept the first offer out of desperation. The freedom to take a health issue seriously instead of pushing through it because missing work is not survivable. A household with enough invested assets to cover even 25% of their annual expenses has correspondingly reduced their dependence on continuous employment by that same amount. Financial freedom, understood this way, is not a light switch. It is a dimmer. Every dollar saved and invested turns it up slightly, and each increment is usable immediately, not just at the theoretical finish line. This reframing matters because the all-or-nothing version of financial freedom, the one requiring $1 million plus portfolio before any freedom exists, discourages the people who need the concept most. If freedom only counts at the finish line, someone earning $45,000 a year with $3,000 in savings has no reason to engage with the idea at all. The finish line looks impossibly far. But the dimmer version is available to that same person starting this month, and it compounds the same way the full version does, just starting from a smaller base. Now bring this to where you actually stand. You likely know your income within a few $1,000s. Far fewer people can state their actual annual expenses with the same precision. Not the budget they intended to follow, but what they genuinely spent last year, all in. That number, multiplied by 25, is your specific financial freedom target. Multiplied by 0.04 in the other direction, your current invested assets tell you what percentage of your annual expenses your assets could already sustain. Most people have never run either calculation. Not because the math is difficult, because the answer, before enough progress has been made, can feel discouraging enough that avoiding the calculation feels easier than confronting it. But the calculation does not care whether you look at it. It is running either way. The only question is whether you are the one steering it, or whether it is simply happening to you while you focus on the number the industry would prefer you chase instead. What does your life actually cost to run? And how much of that number is already covered by what you control? Not what you earn, but what you keep.